So our next question comes from Meta inside of our Instagram DMs. She says, I'm 32 years old, I'm married with a baby on the way, and I've paid off all my student loan debt of $180,000, and my husband has about $25,000 left of student loan debt himself. Now we have roughly $185,000 sitting in a high yield savings account earning about 4% because we thought that we'd be buying a house soon. However, New York City is becoming too expensive and we're considering moving to a different state in the next 5 years, give or take, depending on our childcare situation, since all of our family does live in New York City. Now, my husband has $17,000 in a 401k. I've got $50,000 in a Roth IRA, as well as $30,000 in my bridge account and $45,000 vested in a city pension plan from work. We're currently renting a one-bedroom apartment in New York City for $2,300, and with maternity leave coming up, we anticipate a huge pay cut this year since I make double my husband's salary. What should we do with the cash sitting in this high-yield savings account? I'm afraid to invest it short term and have the markets go crazy and lose some, as well as consider my taxes and all that fun stuff that comes with investing. So I'm trying to figure out what to do. Do we set ourselves up for retirement more by investing this in a long-term account? What do we do here? So Robert, I want to take a first stab at this one.
I love where you guys are at, and I think it's fantastic at your age, how you're looking at money and what you're doing. But I do think you're on the right track. Having that much money in a high yield savings account, whether the markets are turbulent or not, I think is just too much. I would rather see maybe 50 in the high yield savings account, get the other $135,000 working in the markets, especially at your young age, because then it is working towards your retirement, getting it into some of the index funds that we talk about, getting good balance, getting more diversity for the long term. Because are we going to see volatility for the rest of 2025? Probably. Maybe we'll see some downturn through this year and into 2026. Maybe. But over time, you need this money making more than 4%, and you need it active in the market. So I think you're on the right track. I'd get a bunch of that money out and get it activated and then go from there. I think that would be the best plan long term for you, especially because you have a 30-year investment time horizon ahead of you and plenty of time to weather any storms in the market.
So it seems like Meta here has about, between her and her husband, $100,000 invested toward their retirement accounts and their bridge account. And then they've got this 185 that I'm sure they've been saving aggressively for as a down payment on, $800, $1 million, $1.5 million piece of property in New York City, which makes a lot of sense. If I were you, I would probably want to, one, not make any money moves until after your baby has arrived. I pray for a happy, healthy baby, but who knows what could happen. So making sure that you have some of that financial flexibility in case a medical bill that is unexpected comes for something crazy, right? Let's hope it doesn't happen, but no one can predict the future. So I would want to make sure that you're neck high in cash when it comes to making sure that this baby is delivered properly and all is well. The medical bills come, you pay them, you're off to the races now. And then I'd say with what you have left over, you mentioned you'd be making a lot less because of the maternity leave. I would also probably consider using this money to supplement your lifestyle while you're home with your baby. I don't know if that's going to be 3 months or 4 months or 5 months or 6 months, but you should not go into debt or credit card debt or anything like that to supplement your lifestyle while you're on maternity leave. Use this money. That's what it's for. And then once you're back working and your husband's working and, maybe the family's helping with the baby, right? It's not really, things are back to normal, quote unquote. Now it's time to make the decision of one, do we really want to stay in New York for the next 5 years? And if that's the case, $2,300 a month sounds pretty reasonable for an apartment in New York, depending on how your situation is there. So maybe you stick it out for a couple of years and continue to save some money for a big down payment or a decent sized down payment if you end up moving somewhere else in the country with lower taxes and a lower cost of living. But in my opinion, if you do plan to stay in New York for at least 5 years and you don't plan to buy for the next 5 years, putting this money to work in the markets by investing into the S&P 500 and VTI, VOO, things like that are just going to be long standing up and to the right for a long period of time is a really, really great way to make sure your money's growing for you, assuming you're not going to spend it for the next 5 years. And you also like have this long-term vision of what owning real estate could look like in your late 30s and maybe early 40s, and like really flourishing as a family somewhere else in the country that might give you more than, a small backyard and whatever comes with buying in New York. I don't like New York City, Robert. It's cold and it's expensive.
Yeah, I don't like New York either. I like to visit. The commerce part of it is great. We've had some really fun times there. But yeah, I just don't think I would ever want to live in a market where parking is tough and you don't get a yard and there's just not a lot of room and really, really high cost of living. Because a lot of times the increase in wages doesn't meet what the increase in living costs. So it's kind of difficult, but love the question. You guys are doing great. And Austin, I think your takeaway was perfect.